Banking. These 7 bank fees are unlawful to collect from seniors. Stop tolerating them and reclaim what is rightfully yours right now. Your bank has already taken a fee from you this month, perhaps more than one, and there is a very strong likelihood that at least one of those charges was not legally permitted. Not a borderline situation, not a minor technicality. Outright prohibited under federal consumer protection legislation. And the bank collected it regardless, because the overwhelming majority of account holders never question a fee entry on their bank statement. They notice the charge, they assume it must be valid, and they simply move on. The bank holds on to the money. There are 7 distinct fees that federal law and state consumer protection statutes either ban entirely for older adults, restrict to levels far below what most banks actually collect, or require banks to disclose in ways that most institutions are currently failing to follow kurs mithimonokrei of yigoi on just 7 fees. And the seniors bearing the heaviest burden are not the ones managing sophisticated investment portfolios. They are the ones living on fixed incomes, paying these charges every single month out of social security deposits and pension payments. Money they spent decades earning, with no awareness that they had every legal right to refuse those charges. By the time this video ends, you will know precisely which fees to identify on your statement, precisely what federal law states about every single one, and precisely what to say to your bank to recover your money. If this is your first visit to this channel, go ahead and subscribe right now. Professor Kyle Pomerleau covers the tax regulations, banking laws, and government programs that directly impact seniors and retirees each and every week. Free, straightforward, plain English, no product being sold. Hit subscribe so you never miss a video that could put real money back into your pocket. Before I move forward, I need to address something important because 2 types of viewers are already considering clicking away, and both of them would be making a serious mistake. The first type is the senior who banks at a large national institution they have trusted for 2 or 3 decades. They are thinking that their bank would never charge them an illegal fee. That confidence is completely understandable. It is also completely misplaced. The Consumer Financial Protection Bureau has pursued enforcement actions against every major national bank operating in the United States within the last 5 years for precisely the kinds of fees we are discussing today. Size does not equal compliance. It frequently means the opposite. The larger the institution, the more automated the fee collection process becomes, and the less human oversight exists over whether individual charges are actually legally permissible. The second type is the senior who uses a small community bank or credit union and assumes that smaller institutions are equally problematic. They are thinking there is no reason to bother checking because every bank behaves the same way. That is also incorrect. Community banks and credit unions maintain significantly stronger compliance records when it comes to senior fee protections. And even in situations where a fee was charged improperly, smaller institutions are far more willing to reverse it immediately when you can cite the specific law that applies. I am going to identify exactly which group each fee affects most severely and explain what the precise legal argument is for every single one. Nobody watching this video should be able to conclude that this information does not apply to their bank. Stay with me. So why are banks collecting fees that federal law either prohibits or restricts? The mechanism is fairly straightforward. Bank fee revenue operates on automation. A fee schedule gets programmed into a system. That system applies fees to accounts matching certain parameters, and the charge posts automatically. Nobody at the bank looked at your specific account and made a conscious decision to charge you a fee that should not apply to you. The system charged you because it was programmed to charge everyone it possibly can, and it operates on the assumption that most account holders will never notice. The federal laws that shield seniors from particular fee categories, the Electronic Fund Transfer Act, the Truth in Savings Act, the Equal Credit Opportunity Act, and a collection of state-level senior consumer protection statutes, are not self-enforcing. The Consumer Financial Protection Bureau can pursue enforcement actions against banking institutions, but it cannot monitor every single account at every single institution for every improper charge that gets posted. The protection only becomes active when the account holder understands their rights and invokes them directly. A bank with 2 million account holders that charges each one an improper $12 monthly fee collects $24 million per month from people who do not realize they have the right to refuse. You are not a victim of intentional wrongdoing. You are a victim of automation and the institutional assumption that you will not know your rights. Today, you will. My name is Professor Kyle Pomerleau. I have spent decades studying the intersection of federal consumer protection law and the financial realities confronting American seniors, particularly the gap between what the law actually permits banks to charge and what banks go ahead and charge when they believe no one is paying close attention. The situation I find most difficult to witness is the senior who has banked at the same institution for 30 years, who trusts that institution completely, and who has been quietly absorbing fees that federal law either prohibits or caps, month after month, year after year, simply because nobody ever informed them that the law was standing on their side. I have seen seniors recover hundreds of dollars in improperly collected fees from a single conversation with a bank manager, armed with the correct legal citation. The money is absolutely recoverable. The law is unambiguous. The only obstacle standing between most seniors and that money is knowing which fees to challenge and the exact words to use when doing so. That is precisely what this video delivers. Here is what we are working through over the next 20 minutes. I'm going to walk through all 7 illegal or improperly charged fees, one at a time. What the fee is, what federal law specifically says about it, which seniors it affects most, and the exact language to use with your bank to demand a reversal. Then I'm going to add 2 bonus points at the end, including how to file a formal complaint with the Consumer Financial Protection Bureau if your bank refuses to reverse a charge, and how far back you can legally demand a refund. Every fee I discuss today is documented in federal statute or regulatory guidance. Nothing I am sharing with you is personal opinion. It is law. Fee 1. The monthly maintenance fee. Applied despite direct deposit. Bust the misconception. Most seniors believe monthly maintenance fees are a standard, unavoidable cost of maintaining a bank account. They are not. For a significant portion of seniors, federal and state law requires the bank to waive them under conditions that most qualifying seniors never actually invoke. The actual rule, the Truth in Savings Act, requires banks to clearly disclose all fee waiver conditions at the time an account is opened. Most major bank account agreements include an explicit waiver of the monthly maintenance fee when the account receives qualifying direct deposits above a specified monthly threshold. Social Security payments qualify at virtually every major institution. If your Social Security check deposits directly into your checking account and your bank is still collecting a monthly maintenance fee from you, that charge violates the fee waiver terms laid out in your own account agreement. Dual group delivery. For the lower income senior whose primary income source is Social Security, the monthly maintenance fee waiver triggered by direct deposit is your most immediate avenue for relief. The standard refund window under most state consumer protection statutes is 2 years. For the more financially comfortable retiree carrying higher balances, your relevant waiver is the minimum balance exemption. If your combined balance across accounts held at the same institution exceeds the threshold listed in your account agreement, the monthly fee should be 0. One action right now: pull your account agreement from your bank's website, find the monthly maintenance fee section, identify every waiver condition listed. If your account meets any of them and you have been charged the fee regardless, call the bank and use this language. My account meets the direct deposit waiver condition outlined in my account agreement. I am requesting a full refund of all monthly maintenance fees charged during the period my account qualified for that waiver. Fee 2. The overdraft fee. Without affirmative opt-in, bust the misconception. Most seniors believe overdraft fees are simply the unavoidable cost of making a financial mistake. Federal regulations implemented by the Consumer Financial Protection Bureau have substantially restricted the conditions under which banks are legally permitted to charge them. The actual rule: under current CFPB guidance, banks cannot charge overdraft fees on debit card transactions and ATM withdrawals unless the account holder has affirmatively opted in to overdraft coverage in writing. Many seniors who opened their accounts years ago were automatically enrolled in overdraft programs that have since been ruled impermissible without affirmative written consent. Additionally, CFPB guidance issued in 2024 caps overdraft fees at $8. Any overdraft fee exceeding $8 on a transaction that the account holder did not specifically opt in to cover is subject to a refund demand. Dual group delivery. For the lower income senior living on a fixed income, overdraft fees are disproportionately collected from accounts receiving regular fixed deposits, because the timing of recurring bill payments occasionally creates brief balance gaps. If you are never presented with an opt-in form for debit overdraft coverage, every debit overdraft fee you are charged is potentially recoverable. For the more comfortable retiree banking at smaller institutions that have not yet updated their fee schedules to comply with the 2024 CFPB guidance, you may be paying overdraft fees that exceed the current legal cap. One action right now. Call your bank and ask directly, do you have a signed overdraft opt-in form on file for my account covering debit card transactions? If they cannot produce one, use this language. Under CFPB Regulation E, overdraft fees on debit card transactions require affirmative opt-in consent. I have no record of signing any such opt-in form. I am requesting a full refund of all overdraft fees charged on debit card transactions on my account. Fee 3. The paper statement fee. Without proper disclosure busts the misconception. Banks have introduced paper statement fees under the framing of environmental responsibility. But for seniors who never agreed to pay for paper statements, this fee frequently violates the Truth in Savings Act's disclosure requirements. The actual rule, the Truth in Savings Act, requires that any new fee introduced on an existing account be communicated through compliant advance written notice, typically 30 days before the fee takes effect. Many banks introduce paper statement fees by inserting a brief notice inside a monthly statement without obtaining any form of affirmative acknowledgement from the account holder. A fee introduced without compliant advance notice does not represent a valid contractual modification. You did not agree to it. Dual group delivery. For the lower income senior who relies on paper statements to manage their finances, you are entitled to receive a paper statement. You are not obligated to pay for it unless you affirmatively agreed to a fee schedule that included it, with proper advance notice provided beforehand. For the more comfortable retiree managing multiple accounts, the paper statement fee represents a small dollar amount per account, but compounds across accounts and years. The cumulative recovery is meaningful and requires minimal effort to pursue. One action right now. Request a copy of the advance notice your bank sent before introducing the paper statement fee. If that notice was embedded inside a paper statement without a separate acknowledgement process, use this language. Under the Truth in Savings Act, fee changes require compliant advance notice. I am requesting documentation of the advance notice provided for this fee, along with a full refund of all paper statement fees charged without my affirmative acknowledgement. Fee 4. The excessive transaction fee on a savings account bust. The misconception. Many seniors believe savings account transaction limits represent a permanent feature of federal law. They do not. The federal regulation that imposed a 6-transaction monthly limit, Federal Reserve Regulation D, was suspended indefinitely in April 2020. It has never been reinstated. The actual rule, since April 24, 2020, Regulation D no longer requires banks to restrict savings account transactions to 6 per month. Banks may maintain their own internal limits, but only if those limits and their associated fees are clearly disclosed in the current account agreement, with an independent contractual basis that stands entirely separate from the old Regulation D framework. Any excessive transaction fee charged based solely on Regulation D since April 2020 is a fee without any legitimate legal foundation. Dual group delivery. This fee applies equally to both groups. If you hold a savings account and have been charged excessive transaction fees within the past 3 years, review your current account agreement carefully. If it references Regulation D as the sole basis for the transaction limit without providing any independent contractual foundation, then every excessive transaction fee charged since April 2020 is subject to a refund demand. One action right now. Review your savings account agreement for transaction limit language. If it cites Regulation D without establishing an independent contractual basis, call your bank and use this language. Federal Reserve Regulation D was suspended in April 2020 and has not been reinstated. Any transaction limit in my account agreement based solely on Regulation D has no current federal basis. I am requesting a full refund of all excessive transaction fees charged since April 2020. Fee 5. the minimum balance fee. Despite qualifying direct deposits bust the misconception, minimum balance fees rank among the most commonly assessed charges on senior accounts and among those most frequently applied in violation of account agreement terms that most seniors have never read past the opening page. The actual rule: most bank account agreements include an explicit exemption from minimum balance fees for accounts that receive qualifying direct deposits above a specified monthly threshold. Social Security payments qualify universally. A senior whose Social Security income deposits directly into their checking account should not be paying any minimum balance fee under the terms of virtually any major bank's account agreement, regardless of what their balance looks like between deposit dates. Dual group delivery. For the lower income senior, this fee is the one most precisely targeted at your account profile and most clearly prohibited by your own account agreement. The refund window spans 2 to 3 years, depending on your state. For the more comfortable retiree whose balance regularly exceeds the minimum threshold, the minimum balance fee likely does not apply to your situation at all. Your most relevant audit is the monthly maintenance fee addressed in Fee 1. One action right now. Locate the minimum balance fee section of your account agreement. Find the direct deposit exemption. If your Social Security income deposits into that account and you have been charged minimum balance fees, call your bank and cite the exemption directly. Request a complete refund covering the applicable 2-year period. Fee 6. The wire transfer. Fee above the disclosed amount bust. The misconception: wire transfer fees are legitimate bank charges, but only at the amount that was disclosed before the transaction was initiated. Many seniors are quoted one fee by a teller and then charged a higher amount when the transaction actually posts to their account. The actual rule, the Electronic Fund Transfer Act, requires that any fee connected to an electronic funds transfer be disclosed to the account holder before the transfer is executed. If you are quoted a specific fee and then charged a larger amount, the difference is recoverable under federal law. If you are not quoted any fee at all before the transfer was initiated, the entire fee amount is potentially recoverable. Dual group delivery. For the lower income senior who occasionally sends wire transfers to family members, the individual dollar amounts may be smaller, but the principle is identical. Any fee above the amount originally quoted is recoverable with a single phone call. For the more comfortable retiree who conducts larger or more frequent wire transfers, the financial exposure is proportionally greater and warrants a systematic review of the past 2 years of wire transfer activity. One action right now: pull your last 12 months of bank statements and identify every wire transfer fee that was charged. Compare each one against the fee schedule your bank publishes on its website. For any discrepancy you discover, use this language. Under the Electronic Fund Transfer Act, wire transfer fees must be disclosed before the transaction is initiated. The fee charged on my account exceeds the disclosed schedule. I am requesting a full refund of the difference. Fee 7. The inactivity fee on a dormant account. Bust the misconception. Many seniors maintain secondary accounts they use infrequently, an old savings account, a certificate of deposit, and remain unaware that some institutions charge monthly inactivity fees that slowly and quietly drain the balance down. The actual rule: under the unclaimed property laws of most states, funds held in a dormant bank account must be transferred to the state after a specified dormancy period, typically 3 to 5 years, rather than being gradually depleted through ongoing fees. An institution that charges inactivity fees, which erode a dormant account balance before that state-mandated transfer period expires, is violating state unclaimed property law. Additionally, any inactivity fee must be disclosed in the account agreement or through compliant advance notice before it is ever charged. Dual group delivery. This applies equally to both groups. If you have any account you have not conducted transactions on in more than 12 months, and that account is showing a declining balance, the reduction is almost certainly an inactivity fee being assessed. Check your account agreement for any inactivity fee disclosure. If none exists, every inactivity fee that was charged is recoverable. One action right now. Log into every account you hold and examine the transaction history for any charge labelled as an inactivity fee, dormancy fee, or account maintenance on an account with no customer-initiated transactions. If you find one, contact the institution and reference both the Truth in Savings Act disclosure requirement and your state's unclaimed property law as the dual legal basis for your refund demand. Everything covered up to this point gives you the specific legal foundation to recover fees that have already been collected from you. What I am about to share is for the senior whose bank has refused to reverse the charges, or where the total amount involved is significant enough to pursue through formal regulatory channels. If your bank reversed the charges during your very first call, the 7 points above cover everything you need. But if you are encountering resistance, the next 2 points are what actually move institutions to act. Bonus 1. How to file a CFPB complaint that banks take seriously. The Consumer Financial Protection Bureau maintains a publicly accessible complaint database at consumerfinance.gov. When a consumer submits a formal complaint through that portal, the institution is required to respond within 15 days and deliver a substantive resolution within 60 days. That response gets logged in the public database and directly affects the institution's regulatory compliance record. Banks treat CFPB complaints with significantly more urgency than ordinary customer service calls, because a formal complaint creates a documented regulatory record rather than simply a private conversation that leaves no trace. A fee dispute that gets dismissed by a frontline customer service representative will frequently result in a complete refund when it gets escalated through a formal CFPB complaint. Go to consumerfinance.gov, select Submit a Complaint. Choose banking as the product type. Describe the fee, the date it was charged, the amount collected, the legal basis for your objection, and the bank's response to your initial refund request. The CFPB transmits the complaint directly to the institution's regulatory compliance team, not to its general customer service department. That distinction matters enormously. Bonus 2. How far back you can legally demand a refund. The recovery window for improperly charged bank fees depends on the legal basis for your claim and the state in which you reside. Under the Truth in Savings Act, the standard statute of limitations for civil claims is 1 year from the date the violation occurred. Under state consumer protection statutes, which typically offer broader remedies, the window extends to 2 to 4 years, depending on the state. Under state unclaimed property law, arguments applied to inactivity fees, the window may stretch to cover the entire dormancy period. For practical purposes, request a refund covering the past 2 full years for any fee category where you have identified a disclosure violation. Most banks will negotiate within this window rather than face a formal regulatory complaint. If the institution declines to refund anything beyond 12 months, file the CFPB complaint and explicitly reference the applicable state statute of limitations in your complaint narrative. The total recovery for a senior who has been paying 2 or 3 improper fees for 2 years can easily reach $500 to $1,000, achieved through nothing more demanding than a phone call and a complaint form. Let me tie everything together with the single idea that connects every fee we examine today. Every one of these fees shares one fundamental characteristic. The bank did not charge you because you deserve to pay it. The bank charged you because the system runs on automation, and the institution operates on the assumption that most account holders will not know which fees are legally permissible and which are not. The system continues working until someone understands their rights. You now know 7 specific fees that federal law either prohibits, caps, or requires to be disclosed in ways that most banks are currently failing to honour. You know the precise legal citation for each one. You know the exact language to use when you contact your bank. And you know exactly what to do if your bank pushes back. File a CFPB complaint and reference your state's statute of limitations for consumer protection claims. Professor Kyle Pomerleau's message on this channel has always remained consistent. The law is on your side far more often than the institutions collecting money from you want you to realise. The only gap separating you from what you are legally owed is knowledge. You now have that knowledge. Use it. Before you close this video, do one thing. Forward it to one person in your life who is over 65 and holds a bank account. A parent, a sibling, a neighbour, a friend from your place of worship. It does not matter whether they bank at a national institution or a local credit union. Every single one of the 7 fees we covered today appears on accounts at institutions of every size, across every region of the country. And the person you are picturing in your mind right now is almost certainly paying at least one of them. One informed phone call made with the knowledge this video provides, could recover hundreds of dollars for someone you genuinely care about. That is worth more than almost any gift you could offer them. That is exactly what this channel exists to accomplish. In the next video, I'm going to walk you through the social security benefit that the SSA is legally required to inform you about, but that most field offices only mention when you ask precisely the right question. Most seniors who qualify for it have been leaving between $200 and $400 per month, unclaimed for years. I will see you there.